this is Ryan here, your investing companion. Welcome back to the Average Joe Investing channel. So today, I would like to share with you my international portfolio. So if you're someone like me who is just starting out in their investment journey, welcome, and I hope that you can gain something and learn something in my content. With that, let's get started. So today, I'd like to share with you about my US portfolio. This portfolio was started in May 2023 this year. I know, right? What great timing. Right after the tech rebound in 2022. But like the investment grade always say, time in the market beats timing the market. So there's no better time to start than today. Basically, my US portfolio in US dollar term is ridiculously small. Firstly, due to the horrendous exchange rate, I think most Malaysians would understand this predicament. Imagine 10,000 ringgit deposited only equals a mere 2,000 US dollar, not even a starting salary in America. Secondly, I'm just starting out. I just want to put a little bit of money and then just try out and learn along the way. And as I understand the US stock market and the companies better, then I would be more convinced to put in more money. But either way, I've also committed to putting religiously 2,000 ringgit or 400 plus US dollar equivalent every single month into the brokerage account. So, what is my strategy behind investing in US stocks? The strategy is not, basically my strategy is not to try to be the next Oracle, to predict the next Tesla or Nvidia. I wish I was an Oracle. I'm not. I've come to that fact. And secondly, I'm not born in America, so I do not have the circle of competence in terms of geography-wise. Therefore, I only invest in companies that are well-known brands or are really just leaders in the industry with deep and wide moats. Basically, I try to look for companies, I try to look for solid growth companies that are either leaders in their industry, they have predictable free cash flow year over year. And then thirdly, I would like the companies to have pricing power, which also translates to them having an entrenched moat. This can be seen from a higher operating profit margin or a higher net profit margin. And of course, I want to understand and know that the company is being run efficiently. Therefore, I look for companies that have high returns on capital employed, preferably more than 15. And of course, fourth, the companies must not be too overly leveraged. It is okay for the companies to be in debt positions because usually huge companies will take on debt to grow their business. But I want the debt to be controllable, which means that their debt should not be more than 3 times their EBITDA. And last but not least, the companies that will do well, not to say do well as in they can weather through, their business will not be too severely affected in an event of a downturn. And of course, to buy at a great or fair valuation. With that in mind, let's get started. So, the first stock I have in my portfolio is what I know, Apple. Now, Apple, I don't think it needs much introduction. It has a really strong ecosystem with its devices. While many may view that Apple growth being intrinsically linked to its iPhone sales, it derives 51% of its revenue from iPhone sales in 2022. But I think what is more important is what happens after the purchase of the iPhones. And the reason I really like Apple is it has a really great ecosystem, and Apple can monetize its users in many ways. Either it can be through their App Store, iCloud, Apple Music, Apple Fitness, etc. And most importantly, what I find interesting is that although people say that Apple is not innovative, but I think that Apple is really on the top of their game, coming up with many innovative products. And the most recent is Apple Pay. Have you noticed it? Like a few years ago, we don't even see it anywhere. It's just Visa, MasterCard. But nowadays, you go to any merchants and you can see, aside from Touch and Go in Malaysia, you have Apple Pay. Apple is even entering into the finance industry right now. And you can just imagine the things that Apple can do. For example, they're coming up with a VR headset, etc. So I disagree with the view that Apple is not innovative. They are being innovative, but they're being in an iterative manner. And this can be shown from their services revenue, which has grown from a low base of 18 billion US dollar in 2014 to 78 billion in 2022, a CAGR of 20%. 20%. Best of all, service revenue, subscription, are recurring revenue and tends to be more stable compared to devices sales. And as Apple becomes less dependent on their hardware sales and more on their services revenue, I see Apple as a company with a wide moat that's difficult for any competitor to penetrate for the foreseeable future. The second stock is S&P Global Inc. I believe unless if you're in the financial sector, you know what this company is. But have you heard of the S&P 500 index or the Dow Jones indexes? If you've heard of them, then I'm going to tell you that S&P Global owns these indices. But aside from that, S&P Global Inc. is one of the 3 largest credit rating agencies, if not the largest in the world, alongside Fitch and Moody. So what is so great about credit rating agencies? First, it is a really deep and wide moat business because their positions are cemented by law under the nationally recognized statistics rating organizations. Whew, that's a mouthful, or NRSRO for short, and are regulated by SEC. So even if you want to open a new credit agencies, it's really hard for you to do that. Aside from that, why I like S&P Global more compared to Moody's is because they have other sides of their business, such as indices. So indices basically it's tied to the asset under management, and every time any sort of financial institutions who generate or derive a fund based on these indices, they will have to pay a fee to SPGI as well. And recently, with the merger and acquisition of IHS Markit, I believe that SPGI just cemented their positions and their moat because credit rating is a cyclical business, as a higher interest rate will deter government agencies and also corporates to issue bonds. And so with the merger of IHS Markit, it helps S&P Global to become less susceptible to higher interest rate and can provide, because these are more recurring revenues, and can provide a buffer to the cyclical nature of its core credit rating business. And the third stock in my portfolio is MasterCard. Again, MasterCard needs no introduction. It forms a duopoly with another payment processor, Visa. And unlike what most people think, so Visa and MasterCard are not the issuer of credit cards. They're just the processor when you use your credit or debit cards. And they really dominate the electronic payment industry, even though they are like ancient companies. Since Visa is the number 1 taiko, why I choose MasterCard? Firstly, MasterCard has a much faster top and bottom line growth compared to Visa. Second, MasterCard has outgrown Visa in international market, especially in Europe. And thirdly, MasterCard derives more of its earnings from other businesses aside from payment processing and cross-border payments. And that is the reason why I like MasterCard better. Overall, I view payment processor as having a huge runway, especially after the COVID-19 pandemic, which only accelerated digital payment. Keep in mind, there's still trillions of transactions still being made in cash globally. And having such a wide network effect, I believe MasterCard is poised to gain from this momentum. And of course, the fourth is Chipotle Mexican Grill. Yeah, it's a little bit hard on pronunciation. But I believe not many Malaysians know about this company. Basically, it's a fast casual dining company. And I initially had my eye on Starbucks. But the Chipotle, the branding, and the mission just resonated with me more. As you can see, I work out. I hope you can see that. So what I like about Chipotle is that their commitment to serve high quality, customizable, and ethically sourced food. And this has created a very strong brand loyalty. And you go on YouTube and you look at all those fitness influencers, the good ones, okay, in North America, you can see that many a times they go to Chipotle for their fix of a good, healthy meal. And I believe that as the world becomes more and more health conscious, Chipotle will tend to gain. And in fact, Chipotle is not resting on its laurels. They have constantly invested in digital initiatives like mobile apps and online ordering platform and innovative gadgets to streamline and cut down their processes. Their financial performances has proven that. Since the food scare in 2018, Chipotle has rebounded strongly with a 5-year revenue CAGR of 14.04% and 2-year revenue CAGR of 20.12%, which means that the sales has actually accelerated. And aside from that, I just believe that Chipotle has more growth compared to other fast casual behemoth like Starbucks or McDonald's. Just some figures in view, Chipotle only has approximately 3,000 stores in the US and Europe primarily. Whereas Starbucks operates nearly 17,000 stores just in North America alone, and McDonald's operates over 40,000 stores worldwide, which means that Chipotle still has a huge runway of growth in terms of opening of stores and worldwide footprint. And last but not least, what I have in my portfolio is VOO, or Vanguard S&P 500 ETF. As I mentioned in the earlier section, I'm not born or raised in US, so I have a slight disadvantage when it comes to circle of competence. So VOO is more like a hedge for me in case my conservative stock selections bellies up. So I've just been dollar cost averaging a small amount into VOO every month. So VOO is just an exchange traded fund that tracks the S&P 500 index, whereas the S&P 500 index basically compose the top 500 companies in the US by market cap. And it is the benchmark which most fund managers use to track their performance against. And if you can't beat the index, just buy the index no more. And that's all for my US portfolio. And if you like what you hear and see, consider giving me a thumbs up, share, and even consider subscribing to the channel so I can generate more of this kind of useful and interesting educational content. And with that, good luck in your investing journey and see you in the next video.